Hi, everyone, and welcome to the Center for Active Stewardship's panel on green investment policy. We're joined by four distinguished panelists who will give a quick intro of themselves and their work in due time, but I'm going to pause for a second and let folks filter in virtually and join the meeting. So to open things, I want to quickly introduce myself and the Center for Active Stewardship and the Jane Family Institute and the topics that we're going to be discussing today. So my name is Nolan Lindquist. I run a program at the Jane Family Institute that we call the Center for Active Stewardship. CAS is focused on the tools investors have at their disposal to deal with climate risk in their portfolios and hopefully also, I should add, the real economy. In the 2 years that I've been here at JFI, our ambition in the climate and energy space has grown quite a bit. And I would encourage anyone in the audience who's joining because they know CAS to check out the whole slate of events JFI is putting on this week, including if you happen to be based in New York or here for Climate Week, the panel that we are doing tonight at our offices in Soho with happy hour drinks to follow. So I wanted to bring this particular group of experts together because it seems to me that everyone agrees that the policy problem of the climate crisis is something to do with mobilizing investment. The International Energy Agency publishes an energy investment report, and according to them, run rate investment in the global energy system is about $3 trillion a year, about 1 trillion of which is fossil, and 2 trillion of which is either low carbon generation or fuel agnostic. If you then compare that to what's in Bloomberg's economic transition scenario, which is a 2.7 degree scenario where emissions peak pretty much right away, which I would say is probably like the best we could realistically do, energy investment needs to reach 7 trillion a year. And in BNEF's net zero scenario, it needs to go to over 8 trillion. So an additional, call it $4 to $5 trillion a year needs to be directed into the energy system, which is tricky because that mostly means getting private actors to invest in what are often capital intensive and lower returning projects and industries. It's also just a non-trivial amount of money, which I hope should be clear from the trillions aspect of it. Global investment in fixed capital is about $25 trillion a year. So 15 to 20% of that needs to be reallocated from other productive uses of capital, or the total amount of capital spending in the global economy needs to go up. I'm not really sure, and I'm hoping to get a little more conviction coming out of this call. I'm not really sure whether global economic governance as it exists today is going to be able to make that happen. Driving capital spending in the energy system basically means, in my mind, because I'm an analyst, I come from an investment management background, playing with the inputs to a discounted cash flow model. There are two different ways to make that model more appealing and bring more private investment online. One is to make policies at the firm level, like subsidies and tax credits. Those are basically about the numerator of the cash flow model, right? They're about making the cash flows bigger. The other is to make policies that act on capital markets, that are really about making the denominator smaller and lowering the discount rate for green or low carbon or emissions reduction enabling investment. And the panelists that we brought together, who I will give the floor in a second, know a lot about both of these sets of tools. I'm hoping to ask them about how they see these two somewhat different spheres of action fitting together. What does it mean that policymakers are trying both kinds of green investment policy? And what are the implications for how the energy transition is going to play out? And so with that, I want to go around the horn and let our blue chip panel introduce themselves. And Thierry, why don't we start things off with you?
Why not? Very happy to be with you today. It's a great pleasure to be sharing ideas and thinking together on this topic. So my name is Thierry Philipponnat. I'm the chief economist of Finance Watch. Finance Watch is an organization based in Brussels in the EU, and we work on financial regulation, with a motto that summarizes what we do is making finance work for society. So, you know, we're very much into how do we make finance as efficient as possible, taking the public interest into account. And obviously, you know, this is very broad, and an essential topic when you deal with the subject is obviously sustainable finance and orienting capital flows towards the transition to an economy that can make the life on this planet possible. It's just what we're talking about, just that. So we've been doing a lot of work on that, and in particular on the link between climate change and financial stability. You can find our website, so Finance Watch's website, a lot of papers on this, and also on the economic impact of climate change, and more recently on how you're going to be funding all that, which is really the topic we're going to be dealing with tonight.
Fabulous. Thanks, Thierry. Jens?
Yeah,
you're on the spot.
Yeah, really, thanks. Yeah, really great to be here. Really great to be part of the New York Climate Week via this format. I'm a political economist at the University of Amsterdam. That means I look at, from broadly historical perspective, at financial policy, monetary policy. I'm very EU focused in my research. But recently I've been writing a few also more comparative pieces, specifically on why there has been so much climate action in European financial policy and less on the American side. So working paper came out with Brookings with Monica Di Leo and Glenn Rudebush. And I guess that's why it's great to be here to reflect on all the ways in which I think also particularly in the US, there are still many, many ways in which you could use the policy instruments that monetary policymakers, banking regulators, supervisors have to tweak what you already said, the cost of financing clean energy investments and other sustainable products. That's broadly been my focus the past years, thinking a bit about what's happening from that historical perspective, but also often on pushing proposals that I thought would be effective, either on greening monetary policy and also more on the prudential side. Does that give you a first introduction?
Absolutely, Jens, and I'm eager to dig more into both of those things later on in the discussion. Gregor, would love to hear a little bit from you about your background and your work.
Yeah, thanks, Nolan, and great to be here. I work as a senior climate change economist at the World Bank. And let me first give you a disclaimer. What I'm going to say here tonight are my views, and they're not necessarily those of the World Bank or that of its shareholders. And my research in the past has looked quite a bit at the underlying structural change in the real economy that can create transition risks and opportunities. For instance, stranded assets in the oil and gas sector, or opportunities for investment that we're going to be discussing today. But also what that means for energy demand in fast-growing developing countries that tend to shift towards more energy-intensive industrial activities. And since joining the World Bank last year, I've been looking quite a bit at national resilient net zero transition strategies of individual countries, and also at the implications for value chains that arise from the recent slate of industrial policies, which is, of course, also a topic of today's panel.
And Jonas, last but not least.
Yeah. So I'm also excited to be here. I'm an associate professor at Johns Hopkins SAIS in Washington, D.C. My work there, my teaching focuses on green industrial policy broadly, and more specifically on sort of the triangle of China, Europe, and the US in this space. I just left a position at the White House Council of Economic Advisors, where I was the senior economist for industrial strategy. And so I've been thinking a lot about the degree to which climate politics is no longer really driven by the opposition between green and fossil interests, but is much more driven by the size of the decarbonizable sector in each economy. And so I have a new paper out with Niels Kluptak at Columbia that shows that green fiscal spending is really driven by the relative size of these decarbonizable industries in each economy. So the part of the economy that is aligned with the fossil fuel coalition, but can in principle shift. And so we show this, for instance, in the auto sector, but there are others like chemicals, steel, paper and pulp, energy intensive industries. And so governments around the world seem to be striking these fiscal bargains with these firms, offering public support in return for a promise to decarbonize this business model and to shift essentially from the fossil fuel coalition to join the ranks of the climate supporters.
Fascinating. And again, something I want to dig into later on in the call. And I hope as the audience can see, the intent is really to bring together people who have, experience in academic economics and, critical macro financial research in the case of Jens, development finance institutions and industry, and really trying to sort of cross those disciplinary barriers, I think, between the sort of capital markets policy side of driving green investment and the industrial policy or the firm focused set of policy levers that we hear about. I'd like to kind of restate some of the points I made in my opening remarks as a question. And I'd like to ask the panel, we hear about this green finance gap, and we can debate about how many trillions of dollars it is, but it's a big number. And I want to hear you guys dig into conceptually, why can't capital markets provide all of that funding, right? Why are policy interventions needed to close that gap, and why can't private markets rationally allocate all that capital if it's necessary in order to drive towards net zero, which is a goal that the world's banks and large corporations and governments have all kind of nominally signed on to.
So who's starting?
I have two thoughts about this. Happy to jump in. I think one thing to sort of consider conceptually is that the energy transition really is sort of a process of structural change, right? In many ways, it's similar to kind of late economic development, sort of conceptually. And so there's a lot of frictions, transition frictions, and also market failures in this space that need to be resolved for this to be attractive to the private sector. And so you can think about, for instance, EVs and chargers, right? It doesn't make sense to invest in charging infrastructure if there are not enough EVs to really support this demand. But it also doesn't make sense to invest in EVs or to buy an EV as a consumer if there are not enough chargers. And so both of those things need to be there for this to work. And so I think there's a space for policy to essentially resolve that friction, invest in the charger or invest in the EVs, and then the other one will come along. And then all of a sudden you have a case for private sector investment. And then the second thought on this is that we're dealing with this sort of unusual situation where we're replacing an existing energy system that is actually working well. It's just killing the planet. And so this is a sort of once in a lifetime project where we're needing to essentially rip out an entire system, but first build the alternative. And so for a period, we have two systems sort of running in parallel. And again, there's a lot of kind of frictions and kind of market failures in the space that stem from that. And I think government can be key to resolving some of these problems and then letting private actors come in. And I think conceptually, it's also important to think about how do we get to a point where government can eventually pull back and actually let the private sector take over. I mean, this can't be sort of a process of subsidizing this forever. We did that with the fossil fuel industry, didn't work out well for us. And so, thinking about how do we create these markets in ways that eventually the government can pull out is also important.
Can I make one point on that? Because I really agree with that framing in terms of the market failures. And I think this is often where the discussion, particularly if like you have people who are much more skeptical about the greening of finance, the discussion takes a wrong turn. And it's this notion of market failure in this context. The market failures are just so huge, right? The biggest market failure you can imagine. They're everywhere. And then I think it's quick that you lose sight of the differences between, on the one hand, sort of real economy market failures that Jonas just highlighted, which are about, okay, these are different technologies need to be replaced, it needs to be coordinated. That's might not happen automatically. But then there's a separate market failure in financial markets, in not accurately pricing the different future revenues. And I think those market failures are much more difficult to address in some ways, because all the financial policy that we have has a very different purpose than correcting market failures. For fiscal policy, we know how to steer things in the real economy, whereas our prudential financial policy, that's about banks not blowing themselves up. And I think that's where a lot of the things financial policy are difficult. But I think also people shouldn't get away with saying things like, well, we just need a carbon tax, and then the financial side will take care of itself. There's just a second market failure that a carbon tax by its nature just doesn't address.
I agree with what Jonas and Jens just said. I would add another dimension. To your question, why are policy interventions needed? I would tend to give two reasons. The first reason is that, green finance is finance. Sorry for stating the obvious. That means that financiers are going to allocate capital if it provides the return deemed to be adequate to cover the risk they're taking. In other words, is the investment bankable? And one of the dimensions of green investments is that not all of them are bankable, as in providing a sufficient return to attract private capital today, or the unknowns, the risk, or the uncertainty. So there's some very good papers out there talking about radical uncertainty. The uncertainty is such that private capital has difficulty going in that direction. And in all those cases, you are going to need policy intervention to make up for what private capital cannot do. I mean, private capital can do a lot of things. It cannot do everything. I'm not even sure I would call that a market failure, because a market is a market. I mean, it's so, whether, well, we could discuss theoretically whether it's market failure or not. But clearly, there are some cases where private capital will not go, even though those investments are indispensable. This is particularly true, in my view, for transition investments, investment linked to, adaptation investments. I'll give you one very concrete example. The European Environment Agency has put a number on the cost for the EU economy of rising ocean levels. That's €1 trillion per annum. €1 trillion is 6% of the EU GDP. Okay, so rising ocean levels will cost €1 trillion, 6% of GDP per annum to the EU economy. If you want to prevent that, you need to build the right infrastructure, the seawalls, etc. Who's going to finance that? Private capital? Oh, well, private capital needs a return. And those walls, those infrastructure are not going to produce a return. They're just indispensable, because 6% of GDP is not something you joke with. So that needs to be made, but private capital is not going to do the job. And you cannot blame private capital for not doing the job. It cannot do it. So you got my point. Second dimension, we need the second reason why we need policy intervention is information. Obviously, if you want to allocate capital, you need the right information to allocate that capital. And in the case of green finance, I just said it, you need the traditional, I would say, financial information, risk and return, to make long story short. But you also need a clear definition of what green means. What does green mean? What's sustainable? What's behind that big word? And we know this is a big story. So, if we start discussing this, we're going to be together for 5 hours just on this topic. There is the financial materiality, there is the impact materiality, inside out, outside in, etc. So you need to distinguish. But clearly, if you're a financier, you need to know what green means in a very concrete and rigorous manner. And this is where policy intervention is necessary. And there are many initiatives in the world. In the US, you have the SEC standards that are being, elaborated and discussed. At international level, the IFRS Foundation, ISSB, is working on the financial materiality side. In the EU, we have EFRAG, which is basically a European ISSB working on this topic, developing European sustainability reporting standards. But all that is about giving investors the right level of information so that they can make their decisions. If they don't have the information, they won't make the decision. Are capital markets efficient? Well, that's a traditional question in financial theory, but you need to get the equivalent for non-financial, i.e. sustainability information. And this is where policy intervention is needed. I could go on, but I'll stop here. I don't want to be too long. Launch me again if you want to elaborate.
Yeah, let me also say a few words on this. I actually think private capital is going to finance the transition, but the thing is, it's a dynamic problem, of course. If you look at the problem today, it may look expensive or unprofitable, but the structural change that Jonas already mentioned is, it's a dynamic innovation process, and policies are making sure that those cost savings are being achieved and those innovations are being done, that sooner or later lots of the green stuff is going to be a more desirable investment. Now, of course, the problem is that this is supposed to take place very fast, and there are doubts whether the current policy efforts are enough to have that to give it that speed and allow private finance to invest enough to meet this schedule. But there's actually one other issue that cannot really be dealt with by just innovation policy, and that is this problem that capital stock has a certain lifetime, and a lot of the things that are supposed to be swapped out are pretty long-lived assets. So that's an issue that is maybe more on the side of things where you need to divest, but that compounds the problem. And actually, Emily Grubert and Sarah Hastings-Simon have written a very nice paper about the mid-transition, where you have both a fossil fuel system that's pretty large, but not globally, not as large as now anymore. So it's losing scale economies and efficiencies. And you have a low carbon economy that's pretty large. And the two, at some point, they will coexist, right? And you have all of these capital stocks that need to be coordinated, a little bit like the chargers and the EVs. But so that also complicates the financing, I think, and raises questions about policy that coordinates investments. I'll just say one thing that Thierry helpfully also mentioned: resilience and adaptation finance. And I just want to say, I'm not sure I agree that these are not somehow, that they're somehow different than decarbonization finance, because you also, it's not profitable for a company to invest in the grid, and we're not talking about this as a particular issue or in existing ocean walls or bridges. So there's this infrastructure part, which is of course new, and the question is, where does the money come from? But then there are also going to be a lot of things that will make sense from a private perspective to invest in if, God forbid, climate change is getting worse. I'll stop here.
I think a lot of really interesting points. Jens, I want to circle back to something you were saying about how driving investment or driving structural change in the real economy is not historically what policies focused on financial markets, whether it's sort of like interest rate setting by central banks or prudential regulation, driving structural change in the economy or like the evolution of a country's capital stock is not necessarily what they historically have been used for or what they're good for. It's interesting to think about that in light of the different ways that climate policy is evolving on both sides of the Atlantic. In the EU, there seems to be a much more total and complete policy strategy around what to do with financial markets in the transition. And you see that in, you see the outcomes of that in like the size of the labeled debt market in Europe, the rollout of the EU taxonomy regulation, policies that are really focused on helping private capital markets allocate efficiently to transition opportunities and away from transition risks. On the other hand, in the US, the SEC disclosure rule is currently on ice, subject to legal challenges. And with the IRA, you have a much larger sort of fiscal boost to green investment, and one that's really synced up with industrial policy. And so this is a little bit directed at you, but I'm curious what the broader group thinks. Would love to talk more about how these different sets of policies fit together. Are they substitutes? Are they different ways of achieving the same thing? Or do you need both of them to work together? And what does that coordination look like in different regional contexts? Appreciate that I made that a much bigger question, but as I added clauses, but curious what you all think.
Yeah, so first on the point about what historically we have done and what we haven't done with financial policy. Of course, we have historically done a lot more than what became the standard approach in the period between the late 1980s and until a few years ago. And I think that's in many ways quite historically specific monetary policy with this very narrow focus on inflation in an era where, in all fairness, there wasn't really that much inflation to begin with. Can talk about the relations, but in any case, not any broader objectives. And then also prudential policy, financial policy broader, very focused on stability, right? So what you now see in the past years is in many ways just a return to an earlier form of normality, and also normality specifically, for example, in post-war reconstruction, of a much more deliberate guidance of capital in line with policy priorities. And I guess in that sense, then to come to what I think was just the second question on Europe and the US, there are developments very, very quickly in changing norms around what financial monetary policy should be doing. And that's, for example, work at the Network for Greening the Financial System that was only founded in December 2017, very quickly creating a set of ideas around what financial policy, monetary policy could be once you take the transition challenges, adaptation challenges that we're talking about here seriously. And yeah, I think in one sense that's certainly happening in a more ambitious way in Europe. But I also think things are happening in the US. I think things that the Fed does do are made less pronounced, and it's certainly lagging, but it's not lagging that far behind the ECB. If you think that it's only 2 or 3 years ago that the policy action started, only 4 years ago, so that some of these core ideas were articulated, that's not that much lag to begin with. And then on the question of whether these things are complementary or, yeah, I think they are super complementary and they just do different things. As I already said, you should really use policies for the financial system for aligning investment, and then do that alongside all these real economy transitions, all these choices in your energy policy that are also already super complicated by themselves. I don't see any way in which you could sort of genuinely rely on one set of financial policies or really only do the IRA style fiscal policies, and that these things could genuinely work without doing both at the same time.
I mean, I think there's also sort of, I mean, just to push back on the question a little bit, I think there are political and institutional constraints that drive where countries start. and what they can do in different places. It doesn't mean that they don't eventually have to do a lot of these things in all of these places, but it's not necessarily equally easy for everyone to do the same thing, right? And you see this in the European Union, sort of looking at the IRA, there's less fiscal space, the European Union doesn't tax, and so there's all sorts of constraints on copying the IRA in a way. And that's not to say that the IRA is the perfect bill. It's the best bill that we could have in the US within these particular political constraints and the sort of institutional system that we have. And so that's where we started in the US. And so in some ways, I think where countries sort of put an emphasis is not necessarily driven by what's optimal, but what's optimal under these constraints within the sort of circumstances that they find themselves in. And so I think there's a lot of opportunity for learning, but also not necessarily an opportunity to do everything the same way in all of these places.
And you could add a story about how the EU is particularly suited for tweaking all sorts of complex rules, very limited ability, for example, for financial policy, for real sectoral interests to influence that, right? So in this comparative study on the US in Europe, I was really struck how the fossil fuel lobby was able to influence Fed policy, also influence appointment. That stuff just doesn't happen in Europe, right? It's just not the sort of constitutional structures in which you can so directly influence financial policy as a specific sector of industry.
Yeah, I think Jonas is right to insist on institutional and political constraints, because this is the reality of policymaking. So to your question, Nolan, yes, the different pieces of the puzzles are complementary, but given the fact that you start certainly on both sides of the Atlantic from very different situations, from an institutional standpoint, from a political standpoint, that gives what we're seeing. And the example you gave, Jonas, on the IRA is perfect illustration, but I'll give another one. And just to emphasize the IRA case seen from the EU, I mean, the EU has seen what's happening. A lot of people would love to do the same thing, but as you rightly pointed out, there is no fiscal space, not only in terms of amount, but in principle, because there is no such thing as a proper EU budget. EU citizens are not taxed by the EU, but by member states. So, I mean, the EU is not a country when the US is a country, I mean, to make a longer story short. And that has many, many consequences. And basically, the EU is not in a position, even if it wanted to do something equivalent to the IRA today and in the foreseeable future. Another dimension of the puzzle, the EU is doing something that seems to be, and speaking under your control, very politically delicate in the US, which is sustainability reporting. And when you look at what the EU sustainable finance agenda is about, it's about improving the quality and the quantity of information given to investors to allocate capital to sustainable activity. Taxonomy is, as we know, classification of economic activity. What does it mean for when you produce electricity to be sustainable? Response of the EU taxonomy, you produce 1 kilowatt hour of electricity by emitting less than 100 grams of CO2. It's a definition. You have a clear definition. That's what the taxonomy is about. Then you have disclosure requirements for financial firms. You have disclosure requirements and sustainability reporting standards for issuers. So as we can see, all this is about information, giving the right quantity and the right quality of information. And hopefully, if we get it right, it will be, you know, sort of the map to say to investors, hey, this is the direction, this is where you should be going. Doesn't mean, in my view, that will be sufficient, but it's a necessary condition, won't be sufficient. Doing the same thing in the US seems to be politically difficult. I'll stop here. And therefore, you know, even the SEC standards, which by European standards were less ambitious because it was on financial materiality, not on impact materiality, are blocked for the reasons you gave, Nolan. So yes, I mean, different jurisdictions have different constraints, and therefore the complementarity must be difficult. Is difficult, sorry. And certainly in the EU, one thing we've been hearing is that improving the depth of capital markets would be the response of the EU to the US IRA, which I feel, without getting too critical about our leaders, is not the right thinking, because the US has by far the deepest capital markets in the world, but it does do the IRA on top of that. In other words, it puts public money on top of the fact that, yes, I'm repeating myself, but it has by far the deepest capital markets in the world. And if the EU comes even close to what US capital markets can do, it will be a huge improvement. So when the EU thinks that way, in my view, it's not doing its job properly. I mean, it should be thinking, okay, we have a different institutional setup, but when it comes to public money, how can we do something that will enable us to provide public financing where we need it?
Well, I think the other panelists have covered mostly everything. Just add one short thing that maybe is also suffering from the realities that Jonas already mentioned. But I think it's important not to forget that climate change mitigation is its own can be its own goal. I think what we're seeing currently is that a lot of other goals are driving decarbonization, which is great, I think. But it's important not to forget that if these goals shift, then maybe decarbonization is not on the agenda anymore. So that's would be a nice to have. It's already there, but it could be stronger.
I think a lot of really interesting comments from everyone. Thierry, I was particularly struck by what you were saying about the EU taxonomy. I mean, for those on the call who like digging into financial statements, I would encourage you to look at the taxonomy disclosures for a large European industrial or chemical company, because I mean, if you poke through like Air Liquide's taxonomy disclosures, you see all manner of very specific activities where the company might only be generating a couple €100,000 of revenue. And this is a large cap company. This is one of the largest listed materials companies in Europe. And so for certain activities, it really takes the financial materiality threshold really all the way to zero, which is like a fascinating exercise in getting companies to invest, in a sense, in terms of the FP&A and reporting capacity, in bringing this data into the public eye. And I'm curious, like looking across the sort of research and the work you all have done as practitioners, to what extent is data about the structure of the economy and about the sort of like life cycle emissions impact of different investments in the economy a hurdle to effective policymaking or even effective research on these questions? And curious if that's something you all have grappled with as researchers.
I'm sorry, I'm being slow. Can you repeat the angle of your question?
Well, I guess what I'm getting at is I'm curious about the availability of data on what is the physical asset stock of the economy, and what are the sort of like a life cycle emissions potentialities of those chunks of fixed capital, and to what extent can we not do climate policy focused on green investment until we have that sort of detailed information? And is getting that information a barrier in some cases, and curious if you guys have encountered this, in making effective green investment oriented policy?
I can just jump in here briefly. Sorry, Thierry, do you want to go first?
No, go ahead.
All right, I'm just going to say something brief here that, I'm sure more information is always useful, but I think we really know enough about climate change. And when I earlier said, if climate change gets worse, I should have said when climate change gets worse, because we know that, right? So it's really all about expectations. And I think what would be important would be to, as well as possible, align expectations to something realistic that's close to what might happen. But of course, expectations themselves drive what's going to happen. So there's a very tough problem there. And of course, as we all know, the best would be pretty stable policies that can stabilize expectations and therefore guide investments.
I think on the industrial policy side, so I'm not so deeply knowledgeable about the financial market part of this, but on the industrial policy side, I think we're seeing that we don't have enough data to even track whether things are working properly, in part because we haven't ever looked at these industries specifically like that, right? Like you look at US NAICS codes, for instance, to try to figure out what the labor market impact of the stuff is. And we can't break out wind turbines from general, jet engines in this space. And so there's a lot of sort of data collection that happened in certain categories in the past that no longer apply. And so I think there's a lot of work to be done, not necessarily to mobilize investment, but to see if the investment that we are getting is actually having the impact in the places that we need to target. And so I think there's a lot of work left there for all of us. I don't know what that looks like on the European side, but on the US, there's certainly a lot less information about what happens in the domestic economy. I think we know a lot more about what comes in and out because we have good customs data, but sort of tracking kind of a domestic industrial policy project is a new thing for us. And so we don't necessarily have the tools and infrastructures.
Yeah. So I guess what's become really clear on the European side is just how much policy, also financial policy, can achieve in bringing that data out. And then it's not just the corporate disclosures. What's also been, I think, very striking. For example, last week, ING Bank in the Netherlands announced this, that this in part also people have been occupying ING buildings here in the Netherlands. There's been court cases against them, but there's also been just the prudential policy changes that the past year they've been looking at 2,000 large customers, sort of risk categories, thinking about the transition pathways for them, going into conversations with them, and now sort of saying, okay, we are also from part of our, just in the context of our credit relationship, looking at their transition paths, right? So it's not, okay, if a company doesn't have that information, you can't make policy. You can make a lot of policy that force both companies to provide that information, but also in this specific case, financiers to collect that information, to probe it, to ask more questions. And then I think it's for financial regulation supervisors, of course, to check that happens in a proper way. But I guess where initially in thinking about climate and risk, we thought, okay, this might be impossible to measure. I think past 2 years or so, you've seen, hey, it's actually just so much information that banks and other investors can start collecting, and then you do get quite a good grip on some of these risks. Also in light of what Gregor just said, yeah, a few things we just really know, right? Certain sectors shouldn't be doing, and also there are certain changes that we should already start preparing for. That's information we have.
One thing I could add, oh, sorry.
Oh, no, please, Thierry.
Because you alluded to the EU taxonomy of sustainable activities. And one thing you have to bear in mind is that the objective of the taxonomy was to give some rigor to the notion of sustainable. What does it, I gave you an example earlier, but very concretely, here again, the EU is not one country, is 27 different countries. So the objective was, and still is, that if a Dutch investor, an Italian investor, a Spanish investor, French investor, German investor, retail investor buys a sustainable fund, they're going to be buying something comparable. They're going to know where they're standing. What does sustainable mean? Well, EU law is saying, that all the funds claiming to be sustainable will have to give a percentage of alignment with the taxonomy. my fund is X% aligned with the taxonomy. In other words, it's all very well for the people doing the marketing, say, hey, I'm green, I'm sustainable, I'm going to save the world, blah, blah, blah. Fine. Can you give me your percentage of alignment? And then now the Spanish, the Dutch, the French, and the German investors can compare the funds they're buying. And that's a pretty good idea. I mean, implementation is another story. It's become very complicated, so it's not always easy. But the principle, I feel, is sound. It strikes me also that there's been huge debates about that taxonomy, that investors and financiers today sort of like the taxonomy as in they need it, it's a tool for them. Issuers, corporations, they hate it or they don't like it because it's burdensome, it's a lot of work. You mentioned Air Liquide. For a big company like Air Liquide, super equipped, all the best brains and a lot of manpower. I assume, I haven't checked for them, but I assume, it's feasible. For smaller companies, it can become very, very complicated. And it's been interesting even to see that the tensions on the debate have not been as you could have expected between the non-profit sector and the for-profit sector, each side saying, opposite things. It's really been between two sides of the profit sector, for-profit sector, i.e. issuers and investors, which are all businesses. So, but the tension and sometimes the difficult discussions have been between them, which is quite interesting, because basically investors are saying, look, if you want me to invest in a sustainable manner, please give me the information. And the issuers sometimes have a different view.
Enormously interesting answers from everyone. I want to make sure that we're not just limiting the conversation to the sort of North Atlantic world, which to some extent is reflected in my questions and the agenda I circulated, and reflects my own, circle of competence and the limits of my own knowledge. But I think it's important to think about these things in a global context, because the supply chains for batteries, solar modules, and other key building blocks of the energy transition is a global supply chain. And of course, one of the most promising opportunities for a just transition, especially in a global sense, is states in the global south and lower income countries generally pursuing green industrial strategies and using the energy transition as a way to industrialize and move up the kind of global value chain in various ways. And so I'm curious if you guys could talk about the ways in which the policies that are being used by the countries of the global north to drive green investment, to what extent are those competitive with the need of the global south for development capital? And how can these policies be designed in a way that solves for inclusive global growth and not just growth within the borders of one country or one supranational bloc in the case of the EU?
I think that's a tricky one. It's been a big debate. Sorry, speaking about the EU again, that's my experience. It's been a big debate in the EU because obviously, and going back to the taxonomy again, if you take a multinational company, obviously, in different countries, you have very, very, very different ways of operating and ways of assessing everything, really. And the way it's been designed is so much north focused, can I express it like that, that sometimes it excludes de facto activities that are conducted elsewhere. So that's really a big debate, and there's a trade-off, there's an arbitrage between designing all the information so that investors can know they're investing in something which makes sense from an E, from an S, and from a G standpoint, and still investing in the global south, which in particular on the S and on the G has very, very, very different standards. I mean, I don't know if we get into this, but you know, there were huge discussions and fights for, you know, companies working in China. You know, obviously the S and the G, if you work in China, is not exactly the same. You know, I'm stopping here. So what do you do? Does that mean that, you know, an investor cannot invest in a company that does business in China? Yes, no. I mean, it's very, very, very difficult. And I think there's a dichotomy there, and a difficult one to solve, which in my view is not solved yet. But I'm sure my fellow panelists have different experiences, and I'm very keen to listen to them.
Maybe moving from regulation to monetary policy, just one point. I think it's just absolute insanity what we've seen the past 2 years, where because of domestic inflation in a few advanced economies, we've seen funding costs for clean energy projects go up around the world, right? And we know clean energy is particularly sensitive to interest rates. I think here, just in the whole functioning of the global financial architecture, we have a huge gap where we have these interest rates which are set with an eye to price stability, but which we know really impact the relative viability of different energy investments. And if you raise interest rates, then suddenly really dirty technologies like diesel generators and these sorts of much cheaper to buy technologies can become more attractive than solar energy investments. And I think, well, look, there's no one answer to this, but I think part of the story should also be more diversification of the sort of funding that's available globally. And I think also here the euro could play quite a role. Already green bonds are predominantly issued in euros, and I think it would be really important to explore much more how you can use euro-denominated funding also for international clean energy investments.
Well, sorry, maybe a few points. I mean, one, certainly it's great when advanced economies do ambitious decarbonization policies. If these countries don't manage to decarbonize, how could they expect of anybody else to decarbonize? I mean, it's really, you know, from a historical responsibility perspectives, the richest countries have emitted the most and also have the most resources to do something about decarbonization. So that's a plus. Another plus is that, you know, opening up the policy space, you know, what is inside the box, what can be thought about. I think that's a plus. You know, it's an all hands, all policies on deck approach to decarbonization. I think it's a good one. And you know, if all tools can be considered, potentially that's good. Beyond that, I think it gets pretty tricky. You know, there are opportunities, but also large risks. And certainly with the attempt of onshoring manufacturing into high-income countries, that's coveted space, the manufacturing sector as a vehicle of economic growth and development, you know, becomes even more crowded. But and we could probably speak a lot about this, but there's one other elephant in the room, and you know, and that's just how the large requirements for investments will be financed in most countries on this planet. And Jens already mentioned that financing costs have gone up. But so I think that's just a really large challenge given the realities in which we live. But it's one that is crucial because most of the emissions today don't originate anymore in those countries in which it is relatively easy to obtain finance for the kind of investments that we're talking about. But so that's, you know, that's maybe a slightly different challenge from industrial policies. Although it's great when they, you know, lower the costs of the kinds of things that have to be made and built for the whole globe, of course.
I think there is an industrial policy aspect to this, though. I mean, if you think about the IRA, for instance, as essentially a political project, right? The idea here is that climate policy is about building coalitions, economic coalitions in manufacturing, in production, and hopefully bringing people on board, that otherwise might not be so interested in climate policy, then that kind of project needs to be feasible in other countries too, and especially in the global south, where a lot of the future energy demand is, where a lot of the future emissions are. And so, if the Indonesia tried to ban raw nickel exports in order to try to come up the supply chain and so, essentially move into higher value added activities, and the European Union took them to the WTO, and Indonesia lost. And so this sort of competitive space where we're now trying to onshore everything and haven't really articulated a clear strategy for what the role is for developing countries, for the global south in these global supply chains, then means that we don't have a real strategy for convincing them to make the same political bargain with their domestic economies and say, okay, this is a good economic sector, we're creating jobs, we're creating employment, growth from these new industries, and to make essentially an economic argument for climate policy. And so if we restrict them to extractive industries, then I don't think we're going to win this battle globally. And so I think we have to have this conversation about where everyone fits and have some coordination about what the slice of the pie is that everybody gets. And so that can't mean that the US sort of uses policy to become this, completely self-sufficient or export driven, clean energy economy. It also needs to mean that some partners and allies in the global south work with us and don't just send us raw materials, but ideally also get, better parts of these industries domestically.
Really, really interesting. As I think about everyone's comments on this panel, I think one of the really productive elements of this discussion has been that you are all, I think, really focused on the sort of institutional and historical situatedness of policymaking and the ways in which path dependence and different institutional capacities affect what it is possible for different states to achieve. And I'm thinking, Jonas, also of your work on different national innovation systems and the different sort of frameworks for doing industrial innovation in different parts of the world, and your book on that topic. And I wonder if there's an analogy to policymaking and different regional or national capacities for working with and through partners in industry on the part of government. But with that in mind, and with the sort of limitations on what kinds of policies are achievable and what kinds of political or interest group coalitions need to come together to make them happen, I guess I'm curious, as we sort of get to the hour, if you all could share some, a policy change, a policy that's being debated, something that is a live issue around green investment policy that you're particularly optimistic about as you look ahead to the next couple of years, let's say, or pessimistic, if there's at least pessimistic about, if there's nothing that makes you optimistic.
Can we push that response until after November, possibly? I think that would really help.
Yeah, we could, but we're doing the panel today. I guess in all seriousness,
Jonas just gave his response.
yeah. I think that's a very fair response, Jonas.
I think there also, look, it would of course be catastrophic for climate policy if a party that wants to actively cancel anything that's there in the US would come to power. But as Gregor already said, also, look, a lot of the game is in the rest of the world. There's also a lot that can happen there the coming years, and I would hope we wouldn't lose sight of this, and that also globally we find ways to push the clean energy transition in the rest of the world, even if in the US it happens to be a bit of a mess for a few years, and they need to get back to their purposes. So I think a broad range of policies targeting the rest of the world, where it's currently really hard to finance clean energy investments, that's really where the action is for the coming years. And then what shape that should have, that's, I think, still very open, what would work. But I think doing more euro-denominated things could really be promising.
I don't know if what I'm going to say now is optimistic or pessimistic, but I'm certainly convinced that one key issue is to make the assessment of the economic impact of climate change realistic. One of the reasons decision makers, I'm going to generalize, everywhere, all around the globe, are not doing sufficiently on the climate change issue is that economists in general underestimate the economic impact of climate change, and therefore they underestimate the cost of inaction. And if you're a high-level decision maker, let's be honest, it's a very difficult job. You have so many constraints and so much pressure you're receiving and so many difficult things to decide on. If the two-pager on your desk tells you, look, not happy about climate change, but frankly, GDP is going to go down perhaps 2% in 40 years' time. Excuse me, if you're the president or the prime minister of whatever country is saying, you're making me lose my time. Why should I act today? Why should I invest massively? It's difficult. It's economically difficult. It's financially very expensive. It's politically incredibly difficult. If my cost of inaction is not that high, I'm not budging, which is what's happening, because at the moment, we don't have a transition. We're accumulating clean energy on top of fossil fuel energy, but we're not replacing fossil fuel energy for the time being. So in terms of percentage, proportion of energy produced by clean energy, we're clearly on the way up, which is great. But in terms of actual CO2 or greenhouse gas emissions, we're not going down. So we're accumulating, we're not transitioning for the time being, that's the way it is. But back to my point, economists have to be realistic about the cost of climate change. I'm talking about the cost here. I'm not talking about sustainability, happiness of people, or anything like that. I'm talking about money. I have a problem. Basically, economists have to talk to climate scientists. We have climate scientists telling us that +3 degrees is catastrophic and +4 degrees is beyond catastrophic. And we have economists telling us +3 degrees is optimal. We'll have recognized who said that. We got the Nobel Prize for that. And we have the Financial Stability Board telling us that if we have +4 degrees, the stock market will go down by somewhere between 3 and 10%. 3 and 10% drop in the stock market is, it was a bad week this week for the stock market. We'll go up next week. Frankly, nothing to worry so much about. +4 degrees, climate scientists beyond catastrophic, end of the world, disruption of the world as we know it, less 3 to 10% of the stock market doesn't pass the smell test. We know that. I could go on and on about, damage functions and quadratic and et cetera, but the reality is that we're underestimating the cost of climate change. And until that message comes on the desk of the very high level decision makers, we will not do what we need to do. And I'm not being idealistic here nor naive. If we simply want human societies to keep on functioning and being prosperous, because there's no way you can be prosperous without sustainability. Sorry to be stating something so obvious, but in the political debate, it seems to be sometimes forgotten.
Well, I'm glad that Thierry already brought the discussion to the modeling space and damage functions and so on. So I'm going to stay there. I'm going to say a positive and a negative thing if you want, but they're both positive in a way that they're recognized and being worked on in the modeling space. I think one thing is that there are these fantastic graphs that show how the costs of certain low carbon implements, equipment keeps falling below the floor to which the cost could ever fall in a lot of integrated assessment models. So these nonlinear innovation and cost dynamics and scale effects are really something that haven't been fully understood, but I also see a lot of modeling efforts in this space, so that's hopeful. I think that some of the costs are maybe smaller than the costs of decarbonization are smaller than we think. But another thing that I think models are struggling to do are to properly depict how hard it is to move the interconnected but separate and mutually dependent pieces of what is really a network of actors and organizations and nodes to another space. And Jonas already mentioned we don't even know how certain supply chains look like, but you need the whole supply chain to be there if you want to do something else. And all of these complementarities, I think that's often underestimated how hard that is. But again, there also we're seeing lots of effort now in the modeling space. I'll just leave it there.
I mean, I do have some optimistic things to say in the industrial policy space, regardless of how things work out in November. I think there is sort of a conversation starting now because of the IRA and because of China's push into these sectors about how to do this right, how to get industrial policy right, and also what we can learn from different places. I started by talking about the institutional constraints that mean that you can't do everything everywhere equally. But I think there is a lot we can still sort of figure out from one another. We started with the IRA in the US. I don't know if many will probably have read the Draghi report in Europe. Probably no chance of being implemented in that way, but I think analytically it's a very good piece that we can look at here and think about which sectors should we focus on. How do we think about like what can be competitive domestically? I think we can learn a lot from European institutions on workforce, maybe also some of the sort of state-affiliated investment banks like the KfW that we don't have in the US that can sort of, serve parts of the manufacturing economy that are underserved by capital markets in the US at the moment. And in return, I think there's, stuff we can learn from China about how firms became so competitive, what drives these cost curves down quickly. And so I think there is a sort of dialogue starting now about what the different policy tools are that we didn't have before. We hadn't really done industrial policy in this way since, Taiwan, Korea, and Japan became a thing in the 70s and 80s. And so I think I'm hopeful about this sort of conversation yielding better tools and better analysis for how to get this right, and how to get this right, not just in Europe and the US and China, but also in the rest of the world.
I have to say, I'm kind of shocked that it took us 70 minutes to get to the Draghi report. I kind of thought the first name drop would come sooner in the conversation than that. But we should probably wrap things up because I think I blocked out like an hour and 15 minutes on the calendar, and half of you are in a European time zone, and I don't want to encroach too much on your evenings, but I did promise that we would do questions. And so I think we should do one question from the audience and just try and, do a kind of like one-line hot take answer, like a very, just sort of lightning round. James Hassett had an interesting question. He was asking about, he was saying, we've heard a lot on the call about incentivizing private investment in clean energy and the low carbon future, but not about incentivizing the phase out of fossil fuels directly. And he asks, can that be incentivized, or must it be economically disciplined out of existence, I guess by cost competition with renewables?
In my view, the very first thing to do would be to stop the fossil fuel subsidies. I mean, IMF put a number of 7 trillion on fossil fuel subsidies. That's explicit and implicit. Explicit is 1.3 fossil fuel subsidies around the world. That's just above 1% of world GDP. And if you take implicit, which is, externalities basically, you go to 7%. So the very, very first thing to do is to stop subsidizing what we want to get rid of. I mean, that should really be the start. But I don't want to monopolize. I'm sure my fellow panelists have other things to say.
Yeah, just briefly. I mean, on the one hand, I think it's a lot better to have excess capacity in fossil fuels that isn't being used than having too little of it. I think that's calamitous if there's not enough energy to go around. But on the other hand, this excess capacity tends to be used when it's there, because the players who have invested in them really want to make, the return that they expected. So it's tricky. A good balance needs to be found.
I think we absolutely have to incentivize and manage this phase out, right? Like this isn't going to happen by itself. I think also, we've seen that these profits that fossil fuel companies make are not replicable in other sectors. We're shifting from sort of an extractive energy system with huge returns to essentially an energy system that's manufactured, and you just don't get the same returns in that new space. And so this idea that somehow we can kind of outcompete or sort of, transition these business models to kind of, from an oil company to a solar manufacturer, that is not going to happen. And so I think we need to be very conscious of that and sort of manage, again, as part of this kind of structural change perspective, manage the fossil sector out of the economy and make sure that those folks who work there find new sources of employment and livelihoods. And so I think that's something that essentially, again, requires a lot of policy intervention and kind of smart government policy.
And just to add to that, Jonas, I absolutely agree with you. Of course, it should just be left to the forces of the market, right? I was just saying, before you actively shut down capacity in a way that you can't use it anymore, I think it's helpful to have excess capacity rather than too little capacity, but it would be good not to use it. And that's maybe where some of that policy should come in.
Because when you think about, the stranded asset situation narrative, yes, in the medium to long term, fossil fuels are doomed and they will be without any value. In the short term, they're incredibly lucrative, and the return on is remarkable. And that's what Jonas just said. So, this is a time horizon problem, and the only way to solve that problem is public policy intervention. Because otherwise, by definition, people are going to go for the return. It's the nature of the economy, and I was going to say, human nature also. It produces the returns today. Even though, I haven't come across anybody saying that, the stranded asset narrative is not correct. It is correct, but it's a question of time horizon.
Yeah, I think some really thoughtful and interesting points. And, I would just highlight the points about the returns in the upstream business. I think in a funny way, in the post-2020 world, if you look across both IOCs and the E&P universe, in some ways, the business looks more profitable and more cash generative than it has been in a very long time. I would say, the free cash flow of the U.S. E&P group is now in aggregate very positive. The returns on capital employed at the IOCs are much better than in the sort of 2010s regime. On the other hand, I think there's a question of, what kind of systemic risk does this really present? I mean, the whole point of equity, and these companies have very equitized capital structures at the moment, is to let people take on the risk of being a residual claimant of cash flows and potentially earn a higher return for that risk. And so if some investors want to deploy capital in a way where, they might be earning, a high teens return, let's say, if you're really bullish, but are taking the risk of, weak 2030 oil demand and kind of low long-term Brent prices. In a way, I think that's all copacetic as long as there's policy support for substitution on the demand side. And in a way, it's a little bit of a hedge from a sort of like global energy needs perspective. But it's tricky. It's tricky. I personally struggle with the debate on whether, you know, oil and gas investment locks in that capacity and creates you know, a sort of policy interest in preserving the value of those strandable assets. I think it's a really tricky question, and I think a very good one. One that I clearly don't have a definitive answer to, but I'm glad that our panelists do, so that we can all learn from them. I just want to say thank you to everyone. I think this has been a really stimulating discussion. I've certainly learned a lot, and I'm very pleased that there's been, you know, so much rich kind of crosstalk, debate, polite debate on all these points. It gives me, it makes me very optimistic actually about these kinds of conversations that try and bridge different modalities of policy, different, you know, different national contexts, different policy tools, right? Whether we're talking about the industrial policy toolkit of tariffs, subsidies, direct investment, or the kind of capital markets policy toolkit of, you know, disclosures, prudential regulation, classic monetary policy, because I think we're going to need to have a lot of these conversations over the decades to come, and you know, also a lot of far more technical closed door conversations about how to do all these things. And so immensely grateful for everyone joining the panel and participating in such a rich discussion. And I hope those of you in the audience got something out of it as well.
Thank you very much.
And with
Thanks
that,
for having us.
of course,
Thanks.
and with that, you know, to the panelists, enjoy the rest of your day or your evening, as the case may be. And you know, for those in New York for Climate Week, you know, hope that you make it out to our JFI panel and happy hour tonight. Details on the JFI website. All right,
Very
cheers.
sorry. Bye.
Next year, Jens.
I can only hope so.
Awesome.
Bye-bye.
All right. Thank you all.
Thank you.